America's stock market is on fire right now. Major indexes are climbing like they're training for a marathon, and every week there's another headline about some sector hitting a new high. The economy looks tougher than anyone expected, almost stubborn in its momentum. And innovation? It's everywhere. AI labs, energy companies, biotech startups, all moving at a pace that feels almost unreal. But here's the part nobody wants to talk about. The job market isn't joining the celebration. Hiring is cooling. Wage growth is slowing. And more young professionals are starting to feel something they can't quite name. A quiet pressure that doesn't match the booming economy they keep hearing about. So what's really going on? How can a market be this strong while people feel this uncertain? Today, we're breaking down the contradiction shaping America's financial reality. But the job market tells a very different story. While Wall Street is celebrating, Main Street is starting to feel the ground shift under its feet. Job growth is softening, and not in a small, seasonal adjustment kind of way. It's weakening in a way people can feel in their day-to-day lives. Month after month, the numbers are sending the same signal. The slowdown isn't theoretical anymore. It's real. Across tech, retail, logistics, even healthcare, hiring freezes are becoming more common. Companies aren't firing aggressively, but they are quietly tightening. Companies aren't firing aggressively, but they're tightening quietly. Fewer postings, slower callbacks, interviews stretching longer than before. Young professionals, especially those just a few years into their careers, are starting to notice that the path forward feels less like a straight line and more like a foggy road. And behind every weak number is a real person adjusting their life. A couple delaying rent just to stay ahead. A single worker putting off fixing their car. A family skipping a holiday trip because they can't predict what their paycheck will look like 2 months from now. Consumer hesitation is spreading, and it doesn't take a PhD in economics to understand why. When people feel uncertain, they stop spending. When they stop spending, businesses stop expanding. And when businesses stop expanding, opportunities shrink. This isn't panic, it's pressure. A quiet, steady pressure that builds in households long before it shows up in charts. What makes the contrast even sharper is how invisible all this can be. Social media is filled with stories of people landing remote jobs and celebrating promotions. But the average worker feels like they're running uphill with a weighted vest. You won't hear this on earnings calls, but you'll hear it in group chats, in late-night conversations, in the way people pause before talking about the future.
Companies aren't hiring like they used to. I'm applying everywhere, and nothing's moving. I don't know if now is the right time to take a risk. The stock market is glowing. But the everyday economy? It feels dimmer and colder than the headlines suggest. Here's the part most people miss. How can the stock market be celebrating while the job market feels like it's running on fumes? It sounds contradictory. It feels contradictory. But it actually makes perfect sense once you understand how these systems move. First question: why does Wall Street look so optimistic? Because the market doesn't react to the present. It prices the next 6 to 12 months. Investors aren't reacting to the present. They're reacting to the direction of the future. Think of it like checking the weather app. You don't dress for the temperature outside. You dress for the temperature you expect. This is why innovation cycles hit the market before they hit the real world. When analysts see signs of a productivity surge driven by new tech, AI, automation, logistics upgrades, prices move first. Results come later. Second question: so why does the labor market look sluggish? Because jobs reflect the present moment. They're slower, heavier, and tied to real operational needs. Hiring managers don't operate on optimism. They operate on budgets, risk tolerance, and revenue. And right now, companies are cautious. They're waiting for clarity before they expand headcount. This is what analysts call a lag. The economy improves, but the job market doesn't feel it until months later. Now here's the twist most people don't think about. Innovation doesn't create jobs immediately. When a new cycle starts, like the current wave driven by AI, companies don't instantly hire thousands of people. Instead, they reorganize, automate, consolidate. It's like watching two movies at once. In one movie, technology is pushing productivity higher. In the other, job openings are shrinking because companies are trying to figure out how to integrate those technologies without overspending. So yes, the contradiction is real. But it's not chaos. It's a structural shift. And if you understand this shift, you stop reacting emotionally and start thinking strategically. Because the people who win in times like this aren't the ones who panic. They're the ones who know which movie to watch and which one is just a delay in the script. So let's bring this back to you. Because all the charts, forecasts, and economic jargon only matter if you know how to use them. And here's the good news. You have options, and you have signals to guide you. If you're an investor, this is one of those moments where positioning matters more than predictions. The market is already pricing in an innovation cycle, so your job is to build a watch list around sectors showing early signals. Advanced manufacturing, cloud infrastructure, enterprise AI, energy tech, not hype stocks, real productivity drivers. This is where risk management becomes your advantage. You don't chase headlines, you track the fundamentals underneath them. If you're a worker, especially someone early or mid-career, pay attention to the skills companies are doubling down on. The labor market looks slow, yes, but slow doesn't mean dead. It means selective. Hiring is shifting toward roles that plug into automation, data, digital tools, and operational efficiency. This is where reskilling isn't a buzzword. It's leverage. You want to be on the side of the innovation cycle that benefits from productivity, not the side that gets replaced by it. And if you're someone who just wants to understand what's happening in the U.S. economy, remember this. Transitions always feel strange. They're noisy, they're uneven. But this period, this mismatch between the stock market and the job market, is the kind of phase analysts look back on and say, that was the turning point. So your takeaway is simple. Don't panic. Don't drift. Position yourself. Watch the right signals. Build the skills that match where the economy is going, not where it used to be. Because moments like this don't just shape markets. They shape careers. They shape futures. So here we are. On one side, the market is riding a broad rally built on innovation, optimism, and the belief that the next wave of technology is already reshaping the future. On the other side, millions of workers are still waiting for hiring to restart, waiting for stability, waiting for the economy they feel to match the one they keep hearing about. It's like watching a train split into two tracks, one moving fast toward tomorrow, the other slowing down as people stand on the platform, wondering when their turn will come. Two forces, one economy, both real, both powerful. And as this gap widens or narrows in the months ahead, it's going to shape not just markets, but careers, lifestyles, and the way we plan our next moves. So the real question now is simple. Which side of this transition will define the next chapter for you?